Good morning, everybody. It is Wednesday, April 22nd, and my name is Matt Salm. I'm an economist and statistician with the Milwaukee Company. We're bringing you the Milwaukee Company's weekly podcast on Wednesday this week. We're going to try out this midweek recording, see how it goes, and possibly continue doing that going forward. I'm joined this morning by Andy Wilms, who is the president and CEO of the Milwaukee Company, and by Mike Wilms, who is Andy's cousin, and he serves on our portfolio strategy and wealth management teams. Keep in mind that nothing we say this morning is meant to be regarded as investment advice. But with that, Andy and Mike, how are you doing this morning?
I'm doing well, thank you. I'm Andy. Mike is the guy with the funny looking mustache.
I'm the handsome one.
Don't you wish?
So Andy, do you want to start us off as usual with a bit of the market recap?
Sure. Well, market volatility has remained intense, as everybody probably watching this knows, because news is really driving the dramatic shifts in market sentiment. You know, last week the Dow and NASDAQ and S&P were all up by more than 2% as markets rallied on hope that the worst of the coronavirus was behind us. And there was also some reports that patients with severe virus symptoms were quickly recovering after using an experimental drug called remdesivir. Excuse me. But this week, markets have, obviously so far this week really reversed course. Stocks fell sharply Monday as there's been, this historic decline in crude oil prices, and that's triggered broader concerns about the damage the coronavirus might be doing to the economy as a whole. There's also been an intensifying of the debate on how to reopen the economy, and that debate, and combined with the delay in the funding of the depleted small business rescue program, has weighed on investor sentiment. Although I think now we're pretty confident, or quite confident, that the small business program loan program is going to be funded again. The Senate passed the approval of that yesterday, and I think the House is going to follow on Thursday. I think
Thursday, correct.
And things didn't get any better yesterday. The market was down again big as craziness about the oil market raised concerns about the whole energy industry in the U.S. and I think Mike's going to be talking about that. But that's a vital industry, and so a fatal blow to that industry would be really traumatic. And some have speculated, that Saudi Arabia is trying to use this whole crisis to knock out competing oil industries throughout the world, so they're left as the only man standing, kind of thing. We'll see.
And I guess going back to the original Russia-Saudi Arabia dispute, the feeling was that end goal of reducing production here in the U.S. with the shale producers and elsewhere in the world was more a Putin-Russia strategy versus Saudi Arabia.
Okay. Well, so yesterday, just to wrap up, Dow Jones Industrial Average was down 2.6%, and that brought total declines, I should say, in the last 2 days of more than 1,200 points.
I also think it's interesting, I don't know if you guys feel similarly, but how quickly I've become desensitized to hearing numbers like 2% up or down over the past month and a half. That almost seems like a normal day now, but a few months ago, that would have been a huge market move.
That's exactly right. And we were, for a long time, at very, very low, historically, very, very low volatility levels. And now we're seeing those levels jump up considerably again.
And I think the VIX was up like 5 points yesterday, wasn't it? It's back up over 40, which is a volatility measurement.
Yep.
And, the real proof in the pudding was the outsized trading profits that the large Wall Street banks reported last week. Everybody's bond and equity trading profits were up substantially based on the sharp moves up and down in the various asset classes.
Matt, can you tell us anything about what's any news about the coronavirus that you want to share with our viewers?
Yeah, I think some of the most interesting developments are probably playing out state by state in the United States right now. And it's not so much updates on the virus itself as updates on how we're responding to the virus, what policymakers are doing, and what different states are trying. So some states like New York and New Jersey, which have been hit very, very hard, but which also got hit earlier than most of the rest of the country, look like they, may be really flattening the curve. New cases seem to be slowing, and so there are some positive signs there. Definitely encouraging. In Wisconsin, we just rolled out a 3-step approach to reopening the economy earlier this week. Do you guys want to comment at all on that?
Well, it's been very controversial, as anybody who's lives in Wisconsin likely knows. It's a 3-step approach. It's sort of it's intended to sort of follow this 3-step approach that President Trump proposed a few days ago. However, some of the controversy is that the vagueness in how the 3 steps are determined could result in continuing the stay at home and restrictions on business activity too long. People are obviously struggling, not being able to work and feel trapped in their own homes and that sort of thing. So there's some.
It will be a nice thing to go out to a diner and have a cup of coffee with your breakfast. I'll tell you that.
Yeah, I'm sure, especially for a bachelor like you. There's some concern there, and there's some concern that this may result in these lockdown going too extended, for too long a period. But it is a step in the right direction in the sense that we are developing some guidance, so we can kind of plan. There's a 14-day period, for example, of continued decline in new cases to trigger phase 1 of the plan. So there is some indications there, but people say, well, how do we know when that 14-day decline is going to occur? They want more certainty.
Well, I mean, and one of the things that you're starting to see more about in the press is the reproduction ratio. And what that is a measurement of the transmittability of the virus. So if you as a infected person would transmit the virus to 1 or more people, the reproduction ratio would be over 1. And the medical community is viewing the decline in ultimate demise of the pandemic, where once the reproduction ratio drops below 1. And right now in New York, it has dropped to 0.8, meaning for each person that has the virus currently, there isn't another person that's going to get it, or there isn't 2 people that's going to get it. The total number of people with the virus will be dropping. And
that goes right to this point about are the indicators that they're using to determine when phase 1, phase 2, and phase 3 kicked in too lagging, or do we need more leading type indicators that are more active to what's happening today and not looking back 2, 3 weeks, 4 weeks to determine what you're going to do. So I'm certainly not in a position to say what's right or wrong on this, but I think there are legitimate arguments on both sides of the debate.
Yeah, and personally, I think I'm most happy that they're at least focusing the question of when to reopen on the health data. And how exactly we design that system, I also don't feel qualified to comment on. I'm not sure what the right number of tests is or what the reproductive ratio should be of the virus. But as long as we're focusing on the public health side first, that gives me confidence, because it was a public health crisis before it was an economic crisis.
Well, and let me ask you this, Matt, as our technical advisor as well as our economist, can you attach links to news stories to the podcast, so that if somebody had listened to the podcast, I think that CNBC story about the at-home testing potential, where the test has been approved and people can actually test at home now. or will be able to once the tests become available. That goes a huge, that's a huge step in the right direction to get our arms around who's infected, who's potentially someone that needs to self-quarantine, and will go a long way in returning people to feeling safe in public.
Yeah, absolutely. We can include links to different articles and short descriptions of those in the show notes or below the video when we post it. And I think what you were just referencing is another important story, that the FDA did just approve, the first at-home test kit. The research I've done said it's still only available to healthcare workers and first responders because they haven't scaled up production yet to the numbers where it would be, widely available. But certainly it's a step in the right direction.
Yeah. Well, I think as you've seen with ventilator production, the administration will focus on getting the right resources allocated to produce the at-home test kits and get them into the public's hands as quickly as possible.
Matt, is there any other news that you're aware of other than outside of coronavirus that maybe would impact markets this upcoming week that we should be keeping an eye on?
Oh, there's probably 100 different stories out there.
Anything that jumps to mind that you want to attention? One thing that caught my eye, I guess maybe I'll just volunteer a thought then, is that I thought it was interesting this news about Kim Jong-un and the fact that he could be incapacitated or seriously ill. I think that's a story worth keeping an eye on. Mike, any economic or bond information updates that you want to share with us? Maybe something about the oil market. I know you've paid close eye on that.
Well, we have in the previous podcast talked a little bit about the bond market. I'm kind of glad to report there hasn't been a whole lot of volatility there. The Federal Reserve has stepped in and started to implement their bond purchase programs pretty much across all of the different types of fixed income that they've approved asset purchases for. The oil market, I mean, I think everybody is pretty amazed at I actually texted a picture of buying gas at 99 cents a gallon here just recently. And I did see that earlier this week, I think it was on Monday, Wisconsin had the lowest average price for gasoline at $1.26 a gallon.
Wow.
Which is really pretty amazing relative to, it's amazing. It'll be $2 here, and if you're down in Texas, it's $1.50. So, but the occurrence on Monday, the day before the May oil futures contract expired, where you actually had to pay someone to take physical delivery of oil that you owned. It was a unprecedented development. I mean, people just couldn't imagine something like that ever happening, and it's kind of the unintended consequences around a derivatives market that's by and large a highly leveraged kind of investment environment. Oil actually got to, you had to pay somebody $40 a barrel to take it before it closed on Monday, and you had to pay somebody $37.63 to physically take delivery of oil.
Right. And nowhere to put it. There's just, everything's backed up. Even the pipelines are full.
The pipelines are full. All of the ocean-going, very large crude carriers are anchored full of oil. I saw yesterday President Trump was working with the Department of Energy to try and increase storage in the Strategic Petroleum Reserve. I mean, there's just no place to go with the oil, and that's reflected in oil. For June delivery, I think it was like $13 this morning.
Yeah, it's a little under $13. Yeah.
So,
And we've also seen one other economic bit of data. As you know, we're in the midst of earnings week. Our earnings reporting has been kind of going full-fledged this week, and as of yesterday, there were 66 companies that have reported, and their earnings had dropped on average by 28.2%, according to FactSet, which is really dramatic. But the worst is yet to come, it seems to me, because that's just the first couple of months of the quarter weren't as affected as much as what you'll see in the second quarter. And of those that have reported so far this quarter, only two of the 27 energy companies have reported so far, and only 6, which are going to be hit really hard, and only 6 of the 62 consumer discretionary companies have reported, which are also expected to be hit really hard. So corporate earnings are not going to be favorable, going to be very negative, and that could be something to keep an eye on in terms of how the market responds to that data.
Well, and I think an indication is United and Delta Airlines have reported. United's revenues were down 95%, and Delta's were down 90%. So it's by the time we get to early July and start seeing the second quarter numbers, I hope that we're well into a recovery by then, and that we're moving towards a restored economic picture, because the second quarter numbers are going to be bleak.
Yeah.
The other thing before we move away from economic, I think it is important to circle back the fact that the Senate has approved a $310 billion increase in the Paycheck Protection Program. Keeping people on the payroll, having cash to pay for rent and mortgage and food and clothing, and doing their part to support the economy is really an important consideration. And I'm hopeful that the House will quickly approve the proposed package tomorrow as they're scheduled to vote.
Great.
Yeah.
Let's all hope that.
And then moving on to the portfolio management segment that we normally do, we wanted to start off with a kind of broad review of how different tactical or strategic or passive active investing strategies have performed over the recent period of volatility, because people might have seen different things in headlines and such. And so if we can just provide you with a bit of clarity on how things have done, we think that'd be good. So there's been a long-standing debate, as I'm sure most people are aware of, between the proponents of active investing on one hand and passive investing on the other hand. Andy, do you want to weigh in on how active versus passive investing has performed recently?
Well, I think there's really 3 competing camps at this point. Okay. It used to be active versus passive, but over the last 10 years or so, maybe that's 5 to 10 years, tactical asset allocation has sort of become the third camp. And these strategies all really can be defined by their goals. The goal of active investing is to try to outperform the general market by actively trading individual stocks that the investor believes or the manager believes will outperform in the weeks or months ahead, and selling those that they think are going to struggle. So simply put, the idea is to buy winners and sell losers. That's what it boils down to, at risk of being overly simplistic.
Based on fundamental research.
Well, and so in many cases, but not, there are plenty of active investors that some work on technical indicators. They don't follow the fundamentals at all. They just look at charts to determine what they're going to buy and sell. So there's different approaches to each of these strategies, but Mike's right. And for many active investors, they make the decisions based on company fundamentals. Passive investing, on the other hand, is more of the idea there is to generate what Mr. Market or what the market gives you. And say, I'm going to be satisfied with what the market gives. I will take what market returns with a commensurate level of risk. So the idea there is you buy a broad market indexes and hold on to them with very limited trading, basically just to rebalance for changes in asset class weights. You know, if one goes up, you tend to sell that and buy the one that's gone down to keep the weights back to what you originally started with.
And correct me if I'm wrong, wasn't it sometime in the summer where the total assets in the ETF passive realm started for the first time exceeded the actively managed mutual fund assets?
That's entirely correct. But the thing to keep in mind there is you can actively manage a portfolio of passive ETFs, right? So it's not as much as the investment vehicles are one consideration, but how was investment vehicle used is a second one, and that kind of leads us into
leads right into your tactical asset allocation,
right? Which is kind of a hybrid of the two.
See, I just kind of gave you a lead in.
Oh, there you go. I knew you were good for something. The objective with the tactical asset allocation is to try and basically control risk. That's what tactical asset allocation is focused on. So most tactical strategies are designed to give market level returns or potentially a little bit higher, but primarily through controlling drawdowns as compared to picking winners or selling losers. So it does involve trading like active investing, but you invest in passive investment vehicles typically, like a passive investor. One of the fundamental differences between active and tactical is that tactical is driven largely by rules-based strategies that are academically developed, you know, that have sound academic research underlying them, and so it doesn't involve personal opinion as much.
Yeah, that makes sense. So I have a hunch that you have a favorite out of those three. Would that happen to be tactical asset allocation?
Wow, how would you let it get? No, absolutely. Yeah, I am a proponent of tactical asset.
You guys are shameless.
And do you want to elaborate a bit on why you're a proponent of tactical asset allocation?
Well, I mean, there's a couple of reasons. One is because tactical asset allocation trades are directed by strategies that can be tested. So unlike an active investor, there's no way to back test, you know, personal decisions, right? Tactical strategies can be back tested and forecasted. Their performance can be back tested and forecasted by using simulation models. You could see how they would have performed theoretically in a variety of scenarios that may not have actually occurred. And the second thing is the fact that the trading decisions are not driven by the emotional component is largely eliminated. You're not, you know, especially in situations like this where you get, you know, everybody's subject to emotional biases. Tactical asset allocation limits those. Active investing, of course, doesn't.
Well, I think gender does too, right? Women are supposed to be a little bit better at having patience and fortitude when it comes to investing.
I'll take your word on that one.
Yeah, I think those are some pretty big perks to tactical asset allocation, but you know, there's no free lunch in investing. So what are some of the drawbacks that come along with tactical asset allocation?
Well, there are a couple of things. The first is that because they're relying on market data and market data lags, right? I mean, you get reports monthly oftentimes. So, or if you're lucky, maybe every 2 weeks or so. Since the data lags, the tactical asset allocations struggle in responding to really sudden changes like we're experiencing now. And secondly, when markets change directions quickly, tactical asset allocation strategies can be whipsawed by sudden changes in direction.
Yeah. And we've talked about whipsaw before on the program, but for people who maybe are listening for the first time, could you elaborate a bit on what whipsaw is?
That's simply where you end up getting you buy a stock or you sell a stock at point A when the market's on its way down, for example, and then the market recovers before you get back in, so you buy it at a higher price because the market rebounded so sharply, and you end up getting whipsawed. You pay more for something that you sold very recently.
Okay, yeah, selling at a low point, buying at a high point.
Right.
But
Yep.
don't lose sight of the fact that passive and active management are subject to the same whipsaw event. I mean, and active potentially to the greatest degree because the manager has made specific selections around his opinion of the market. And if his opinion is wrong or his fundamental research is flawed, he's going to be subject to an even worse outcome.
Yeah, that's a very good point.
You mentioned that whipsaw is more likely possibly during times of intense corrections, steep drop, steep recovery. So how has tactical asset allocation performed in our recent period of super heightened volatility?
Well, unfortunately, up to this point, we're only mid-crisis, so the jury's still out, obviously. But up to this point, I would say, by and large, tactical asset allocation strategies haven't done a great job of dealing with this current crisis. And there's probably several reasons for that. First of all, because this is so unprecedented that there's been no back test that you could design that would have factored in what's happened. Right, it's just outside. It's what they call a tail risk event, and so tactical asset allocation strategies really aren't designed to deal with that. And secondly, because the market came down so quickly, again, the lag that we talked about a moment ago did take a toll on tactical asset allocation strategies. And thirdly, because most tactical asset allocation managers are recognizing that we do have a risk of a very sharp recovery at some point, whether it be quickly, the V-shaped recovery, or it's a few months after, and the so-called U-shaped recovery. And sooner or later, there's a significant chance that the market will come up very quickly. So to avoid being whipsawed, you stick with the allocation to equities, even though your strategies might have said take risk off the table and buy bonds, after the market had fallen. Since the market continued to fall, the decision to hold on, to maintain your current asset allocation to avoid whipsaw risk has been detrimental up until this point. Now, once the market recovers, that higher equity allocation should be rewarded, but you won't see it in portfolio returns at this point.
Well, I would also point out that with the 10-year Treasury at 60 basis points, the potential for a major decline in bond prices as interest rates go up would magnify the recovery of the maintained asset allocation, and it would be extremely detrimental if you had rebalanced with a heavier weighting to fixed income.
Well, this is a great point, and if I can just to elaborate that a little bit, that's one of the things that has also interfered or adversely affected performance of some tactical asset management strategies, because decisions that would have been prudent before the crisis were undermined by the crisis, which was unpredictable. And this is one of which you're just kind of referring to here, Mike. Pre-crisis, for example, many of us were telling our clients we should avoid some of these longer duration type instruments. Long duration is a measure of interest sensitivity for a fixed income investment like a bond. So the yields were so similar on long-term bonds and short-term bonds. You've all heard of the yield curve flattening. The difference between long-term rates and short-term rates were getting so close that it didn't make a lot of sense based on that information to invest in long-term instruments, because you weren't getting paid for the additional interest rate risk that is inherent in a long-term bond. And the reason that is because if rates go up and you have a 30-year bond at 4 or 2% or something, 3%, you're stuck with 3% for a long time. The price of the bond goes down to reflect that. Whereas if it's a 1 or 2 or 3 year bond, the bond's going to expire. You can reinvest at higher rates. So staying on the short end of the interest rate curve made sense. But then all of a sudden you have this coronavirus outbreak and everybody's flying to safety. So if you weren't in, long-term treasuries went up like, isn't it about 20%?
I think 23% year to date for some of the big long-term treasury ETFs.
Yeah. So any tactical asset allocation strategy that didn't have exposure to long-term corporate bonds, I'm sorry, long-term government bonds missed out on that. So their performance comparative to a benchmark, let's say that included it, is going to be troublesome. And there's another example, Mike, you mentioned the corporate bond market a moment ago, and the fact that the government has really stepped in and sort of saved the day for corporate investment.
Buyer of last resort,
right.
To prevent a market meltdown, for lack of a better description.
Right. And so, if a lot of people were concerned about that potential. When you bought into a corporate bond ETF, you were sort of expecting it to behave in a certain way, right? Based on its historical performance. And once this whole coronavirus kicked in, you saw there were all new types of risks, this risk of dramatic downgrades that weren't inherent in the investment that you thought you were investing in. The prudent thing, it seemed at the time, was to get out of it. And because if the government hadn't stepped in, hadn't done something it never did before, you would have been in corporate bond ETFs that would have likely gotten crushed. Now, as it turned out, the government ended up bailing out the corporate bond. And so the people who did get out, perhaps prudently, you could argue, ended up losing out on that, or missing out on that upturn. So that was where,
I think you call that they got whipsawed, right?
Yeah, kind of. Yeah. Well, if you only whipsawed if you bought back in, but the passive investor didn't have that problem, right? Because the passive investor would have just said, I put on my blinders, I don't pay attention to what's going on in the market, I won't sell my corporate bond ETFs. In this case, that lack of action proved to be beneficial, but it came at a very high risk. Because if the government hadn't stepped in, which nobody knew what they were going to do at the time, they would have ended up suffering dramatically.
Yeah.
So I hope that answers your question. Rather long answer to a short question. But for a variety of reasons like that, there's no doubt that both active and tactical investment strategies have underperformed a passive approach up until this point.
Yeah. And I think it was really great getting into the weeds of the fixed income market. They're talking about the differences between corporate and government bonds and talking about how important duration was. Sometimes when we just talk about stocks and bonds, a lot of the richness of the discussion gets lost. So I was curious if you could bring some of that nuance to the discussion of stocks as well, or equities, and maybe get into some details of what sectors or segments of the market have done well or which ones have done poorly, and if there were any traditionally good ideas such as diversification that might have been harmed a bit.
Well, I'd be glad to. Now in this area, this is where active investing had maybe an advantage over some active investment strategies have had advantage over both passive and tactical. Now, I mentioned previously they have a lot in common. Tactical would be some hybrid. One of the things they have in common is, generally speaking, both passive portfolios and tactically managed portfolios are well diversified. You try and invest in all of different types of asset classes because history has demonstrated time and again that by investing in diversified portfolios, you end up generating higher rates of return over the long term because you minimize risk. One thing goes up, the other thing goes down, so your average is the average is 2 up. Active investors aren't constrained by the rules of diversification. They pick what they think is going to do well. And for a long time now, large cap growth stocks, U.S. large cap growth stocks, have dramatically outperformed virtually every other asset class. So if you're an active investor who favors large cap U.S. growth stocks, you've been better off you've been benefiting from that preference. If you're an active investor like small cap or mid cap, you've been getting harmed or value like Buffett. He's an active investor who prefers value company largements. That's been lagging or hurt. The coronavirus only magnified that because it's the large cap U.S. growth that has been by far and away the top performers in the market because of things like Netflix, that's done outrageously well. And, Amazon has done extremely well. The whole movement to more technology in our business lives and our day-to-day home lives has resulted in these tech companies doing extremely well. Whereas if you're diversified, like a passive investor or a tactical asset allocation investor, you're going to have exposure to asset classes that have done very poorly in here. For example, REITs have been really struggling. So if but does that mean diversification is a bad idea? I personally don't believe so. I think it's still the best way to proceed to manage a very important risk management tool for a long-term investor.
Yeah. And I think over the long term is key. Earlier, Mike mentioned, and maybe it was you, Andy, like we're not even out of this crisis yet, right? The jury is still out. We're midway, through it.
Right.
So we're not even sure what's going to be the best performing asset classes by the time this crisis is over.
Right.
And certainly we can't know. No one has a crystal ball. We can't know what's going to perform the best over the next 5 to 10 years. So diversification would still have its merits.
Right.
Absolutely.
And another thing that I just mentioned real briefly is that tactical asset allocation has been more, if you've been more stagnant and maintained your equity allocations here, even though typically you would have lowered them as a result of the increased risk, you have the potential for a better outcome when the virus or the crisis ultimately resolves itself. But it's going to require some patience to capitalize on that upside down the road.
Yeah, that makes sense. Mike, did you have anything to add while we're discussing some of the nuances of the equity market?
No, I think Andy did a pretty good job of covering the primary considerations. So
that's about as close to a compliment as I'll ever get from him.
to say that.
Okay. Yeah. So one last thing I want to circle back to there was you talked about delaying rebalancing a little bit, or kind of not lowering your equity allocation even though volatility has been high. Any words to investors who are maybe struggling with the intestinal fortitude to stick it out with that strategy as things are tough?
Well, just keep in mind that you're not alone. Okay, this is a common, pervasive situation, and even the index funds have not rebalanced as they normally would. They've delayed rebalancing. SPY, the largest ETF traded on any equity-based fund, did not rebalance on its normal time frame because they know that it would result in things being so out of whack. So everybody's expecting at some point a return to normal. So you want to take comfort in that, and take comfort too that while there have been some strategies and portfolios that have greatly outperformed because they happen to get it just right. For every one of those that got it just right and really outperformed, there's probably 3 or 4 that have done a lot worse than a passive portfolio or a tactically managed portfolio because they got it just wrong, so.
Yeah, that makes sense. Well, thank you guys, as always, for taking the time to discuss things this morning. As I mentioned at the start, we're recording this on a Wednesday. We're trying out that new schedule, and that's partly because we have a new newsletter that we're sending out at the end of the week. So I'd strongly encourage you to go over to the Milwaukee Company's website or go to themarketcommentator.com where you can sign up for our new newsletter. And if you have Twitter, please consider following us on Twitter as well at the Milwaukee Co. Or you could just Google the Milwaukee Company Twitter, and you could probably make your way over to our page to follow us there. So thank you for listening. And Mike and Andy, again, thank you.
Thanks much. Bye now.
Yeah.
Have a good day, guys.
Yep. Stay safe. This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.